Welcome to the Preparing for Retirement webinar. This presentation is for those of you nearing or considering retirement. In the session, we'll provide an overview of the UC retirement plan, the retirement savings program, and also the process for electing retirement. We'll also direct you to additional online resources and tools to uncover more detail about your pension benefit and the retiree health benefit program. In this session, we'll look at your UCRP retirement pension and how it's calculated. We'll discuss the monthly retirement income options, lump sum cash out options, look at how your paycheck is calculated in comparison to the retirement check, discuss other resources of retirement income, including the capital accumulation payment, retirement savings program, Social Security, and other retirement system agreements. We'll discuss how to elect retirement and also what you can expect once you've retired. There are additional resources on the UCNet website. There is a roadmap to preparing for retirement that you can access, and on it you'll find additional resources such as the retirement handbook, as well as copies of the presentations. You can visit the below website to find more information. Before we get started, I'd like to point to two additional webinars that you can attend to understand more in depth the UC retirement process and your UC retiree health benefits and the options that are available. The UC retirement process is offered on the fourth Thursday of each month at 10 o'clock. We recommend this presentation for those of you who are close to retiring or who are planning to retire from UC in the near future and want to understand the formal process for retirement. It's a step-by-step overview and includes a presentation of the preparation of the personal retirement profile, the retirement election, and what you need to know about transitioning from employee to retiree health benefits. We also offer our UC retirement retiree health benefit webinar. This is offered on the third Wednesday of each month at 2 o'clock. And in this webinar, we'll discuss in greater detail all the UC health benefits that you may be eligible to receive in retirement, what plans are offered in California and outside of California, how your UC medical benefits will coordinate with Medicare, and we'll address common questions that you might be asking as you make that transition from active employment to retiree health benefits. Now, these webinars, in addition to this one, are designed to build on each other and provide you with the important information and details that you'll need in order to make your retirement elective decisions and understand how these benefits can support you and your family in retirement. In some cases, it helps to attend these webinars more than once, as you'll always learn something new. I'd also encourage spouses or domestic partners, if you have one, to attend these webinars as well, as they often have questions that they need to ask. So let's go ahead and begin and look at the UC retirement plan. Your benefits under UCRP will vary slightly depending on which tier membership classification you're in. Our traditional tier is the 1976 tier. It's for those of you who entered UCRP prior to July 1 of 2013 and have not incurred a break in service. Most 1976 tier members are coordinated with Social Security, making contributions into UCRP and paying Social Security taxes. University also pays Social Security taxes on their behalf, which means that they'll likely be eligible for Social Security income as well as a UC pension. A small number of 1976 tier members are not coordinated with Social Security, meaning that they don't pay Social Security taxes, and UC doesn't pay Social Security taxes on their behalf. This can also include safety members who are UC's police and firefighters. If you became a member of UCRP on or after July 1 of 2013, or were rehired on or after that date, but before July 1 of 2016, you're a member of the 2013 tier. Several unions negotiated a modified version of the 2013 tier, so your benefits could vary, so you should check your collective bargaining agreement for more information. If you became a member of UCRP on or after July 1 of 2016, or were rehired after this date, you're a member of the 2016 tier. Again, if you're a member of a union, your benefits could be different. In certain cases, you could be a member of more than one tier, in which case you'd be considered a multi-tier member. For those of you who worked at UC before July 1 of 2013 and then returned after July 1 of 2013, you could have earned benefits under both the 1976 and the 2013 tier. Now, while many of the benefits in UCRP are the same for all members, please note that there are differences between these tiers and will be pointed out along the way. Let's go ahead and look at eligibility for the UC retirement plan. Most employees become members of UCRP when they're first hired into an eligible position, which is an eligible title, an eligible employee class, at 50% time or more for a year or more. If your appointment didn't qualify initially, you can also become a member if you work 1,000 hours in a 12-month period in an eligible position, or in certain situations for academic lecturers, 750 hours. Now, certain appointments, such as student titles, postdoc positions, positions through the temporary employment service or temp pool, per diem positions, visiting titles, and other situations don't qualify for UCRP membership. Now, participation is automatic for those of you in an eligible position. However, if you were hired on or after July 1 of 2016 in a retirement choice eligible position, then you must choose to participate in the UCRP under the 2016 tier to begin membership. Now, regardless of when you became a UCRP member, you become vested and are eligible for a lifetime monthly retirement income once you earn 5 years or more of service credit as a UC retirement plan member. If you're a safety member or a member of the 1976 or modified 2013 tiers, you may retire and receive UCRP benefits at any time beginning at age 50 if you're vested. If you're a member of the 2013 tier or 2016 tier, you may retire when you reach age 55 once vested. Now, even if you leave UC employment, you may be eligible for UC pension as long as you're vested and don't take a refund of your UCRP contributions. You'll be an inactive member and be eligible to collect retirement income at any time after meeting the minimum retirement age. Now, before we get into greater detail of how to calculate your UCRP pension benefit and how you can maximize your potential retirement income, there are two important dates you should consider. The first is your UC separation date. This is your last day of employment at the university. It's oftentimes also known as your termination date. And that date can be a working day, a day that you're on vacation or sick leave, or it can even be a weekend. It may also be a day where you're on paid or unpaid leave of absence. But in all reality, it's the last of your employment at UC prior to your retirement date. Now, your retirement date, that's the effective date of your UCRP retirement benefit. It's the first day you'll receive benefits from UCRP, and it's the basis of the retirement calculation. Your retirement date can be the day immediately following your separation date or anytime after your UC separation date. The choice of separation date and retirement date will impact the benefit calculation and other benefits that you may be eligible to receive. Now, despite variations in tiers, the basic formula for calculating your basic retirement income benefit from UCRP is the same. There's three factors that are used that are based on your age at retirement, your years of UCRP service credit, and your highest average plan compensation, or HAPC. Now again, this is a simple formula. Your age factor at retirement multiplied by your service credit multiplied by your HAPC will equal your basic retirement income. Now, understanding these factors will help you in deciding when it's the right time to retire, and also to help you maximize your benefits from UCRP. So let's go ahead and look at the first component of the retirement formula, and that's the age factor. The age factors depend on the tier that you're in, but in general, the minimum age factor is 1.1%, and that's for somebody who is at the minimum retirement age of 50 or 55, depending on your tier. And it's indexed on a monthly basis until you reach the maximum age factor of 2.5%. For those of you in the 1976 or modified 2013 tier, maximum age factor occurs at age 60. For those of you in the 2013 or 2016 tier, then the maximum age factor occurs at age 65. Because it's increased on a monthly basis, if your birthday falls on the 5th of the month, you may consider whether it makes sense to retire on the 5th of the month as opposed to the start or the end of the month based on that age factor. So in general, the older you are, the higher the age factor and retirement benefit will be, up to the maximum age factor. For those of you who are safety members, the age factor is 3% at 50 and older. The second factor is service credit. Service credit accrues based on actual time worked in covered employment. 1 year at full time equals 1 year of service credit. If you work part-time, you'll receive proportional service credit based on your percentage time worked. So for example, if you work 50% time, over a 12-month period, you would receive half a year of service credit for your year's work. Now, time worked in ineligible appointments such as student, temporary positions, per diem positions, visiting titles, positions that don't qualify for UCRP membership prior to entering into UCRP would not accrue service credit. You also don't accrue service credit while on unpaid leaves of absences. However, for unpaid leaves, if you return to work in active pay status following your leave of absence, then you have the option actually to purchase service credit for that period. There's a publication available on UCNet. It's called the UCRP Service Credit Purchase UCRP Service Credit Purchase Guide, and it describes the provisions and gives you an idea as far as how the costs and the effect on your pension benefit could be. So if you have prior leaves of absences, it's certainly something to take a look at to see if it might be worth purchasing that time. Now, if you have unused sick leave at the time that you retire, and as long as you elect a monthly retirement benefit within 120 days of your UC separation date, your unused sick leave can convert to service credit. Now, one thing to note is that you can't use sick leave to become vested, so the sick leave conversion would benefit your calculation, but it wouldn't qualify you for the pension through vesting status. Now, your sick leave would convert. Your sick leave would convert based off a ratio of 2,000 hours. So the simple way to do it is just to take your unused sick leave balance divided by 2,000, and that would translate to the number of additional years of service credit that would be used in calculating your pension benefit. So if you had 1,000 hours of sick leave, for example, that would translate to half a year of service. There is no cap on the amount of sick leave that can be converted. So, if you have 3,000 hours, that'll translate to 1.5 years of service credit. Any unused vacation And comp time or PTO would be paid out on your last paycheck. So that'll be paid out as part of the separation process between your department or your location and the UC Path Center. So unused vacation would not convert over to service credit. Now, some employees might arrange to increase their 403b, 457 contributions in order to tax defer as much of that money as they can into their retirement savings program. And you would do that through the Net Benefits Fidelity portal. Other employees, and this is subject to department approval, but based off of personnel policy as well as any collective bargaining agreement that your position may be subject to, may elect to run out some or all of the vacation leave in advance of retirement. As an example, if you have 384 hours of vacation on the books, and you decide to retire July 1, for example, then working with your department, if they will approve that plan, possibly you could stop working towards the end of April or early May, run your vacation as time for May and through June up until your separation date of June 29th, for example, retire July 1. And that would allow you to actually use that vacation as time in advance of retirement. Again, that's subject to department approval, so you'll need to work with your department if that's an option that they would permit. Now, the last factor that's used in calculating your pension benefit is your highest average plan compensation, or HAPC. Your HAPC is essentially your highest average monthly salary over a consecutive 36-month period, and it's based on your covered compensation, which is the full-time equivalent paid for your normal and regular appointment. For example, if a person who's working 50% time for an annual full-time salary of $100,000 is paid $50,000, so the salary that'll be used in the HAPC calculation is the full-time equivalent, which is $100,000. Administrative stipends and shift differentials are also included in your HAPC. So in general, your HAPC is your last 36-month period, because as we progress through our career, we tend to make more. However, if there are different periods in your career where your HAPC was higher, then your benefit will be calculated based on the HAPC from that period. Additional salary you may receive may not be included in HAPC, such as overtime, summer salary for academic appointments, and then also the negotiated annual addition and incentive compensation for health science employees. So if you're a health science faculty, what is included as covered comp are your X and X prime pay components. What is not included in the HAPC are your Y, which is the negotiated component, and any Z payments, any incentives or bonus pay that you receive. In addition to these exclusions, the Internal Revenue Code also imposes limits on salary that can be included for pension purposes under IRC Section 401A.17. The current limits for the plan year 2022, which runs July 1, 2022 through June 30th, 2023, are listed on UCNet, as well as displayed here, and can vary based on your entry date. So for new employees who were hired on or after July 1 of 2016 and elected to participate in the 2016 tier through pension choice may also be subject to the Public Employee Pension Reform Act, or PEPRA. This is California legislation, and it limits the covered compensation further than the IRC limits it. So currently, the PEPRA limit is set at $134,974. These values are being reindexed. They're reindexed basically on an annual year, just subject to changes in the Consumer Price Index, or CPI. So for 2023, starting July 1 of 2023, these limits are going up to $490,000, $330,000, and $146,042 respectively, according to the slide. Now, contributions into UCRP stop once the UCRP compensation limit in the fiscal year is reached, and any compensation that is earned above that limit cannot be considered for HAPC purposes. Please note, again, that these limits are reindexed annually, so if your HAPC is from a prior period, it'll be affected by the limits that were imposed for that applicable calendar year in which the salary was earned. Now, there are additional adjustments that may apply to your HAPC. If you're a 1976 tier member coordinated with Social Security, your HAPC will be reduced by $133. And this is to account for both yours and the university's contribution to Social Security. This will reduce your benefits slightly, but if you choose a monthly retirement income and are under age 65 at the time of retirement, you'll receive a temporary Social Security supplement to restore the offset until you reach age 65. This offset and supplement apply regardless of when you begin collecting your Social Security income. For those of you in the 1976 tier and safety members, you may be eligible for an inactive cost of living adjustment or inactive COLA. As previously mentioned, if you separate from UC employment and are vested, your HAPC will earn an inactive COLA each July 1 after you've had a break in service of at least 1 day. And this COLA is earned on the HAPC and will increase your benefit when you retire. So for example, if you were separated at age 45 and retire at age 60, your HAPC could have earned an inactive COLA each July 1 since you've left. You need to only be inactive for 1 business day. So if you separate on June 29th in most years and retire July 1, you'll earn the inactive COLA for that year. The inactive COLA is limited to 2%. Now please note that there's no inactive COLA provision for those in the 2013, modified 2013, or 2016 tiers. Before we continue, we should point out 2 additional limits on how much income you can receive from your pension. Regardless of your age, years of service, and salary, you can never receive more than 100% of your highest average plan compensation at retirement. In general, this means once you've reached the highest age factor, at age 60 or 65 for most members, and earned 40 years of service, you can't get a higher benefit unless your HAPC grows. Safety members reach this limit at age 50 with 33 and a third years of service. Now, this limit also includes any service credit that was awarded to a former spouse or domestic partner in a qualified domestic relation order. The Internal Revenue Code 415 also limits payments to individuals from a pension plan. If you've earned benefits greater than the limit, then UCRP may restore the difference through the 415 restoration plan. For more information, visit UCNet. In the search bar, you can just type in restoration plan and it'll bring up a list of documents, either the website or web pages or publications that address this. Also, during the retirement process, if your record is identified as possibly being subject to the 415 limit, then information will also be provided at that time. Now that we've discussed the factors in the pension formula, let's look at an example to see how the UC pension is calculated and the different monthly payment options. Here's an example of a member who is in the 1976 tier, coordinated with Social Security, and is considering retirement at age 60. To calculate the member's pension, we take the age factor for age 60, which is 2.5%, multiply it by their years of service. So let's say they have 20 years of service. And that yields a benefit percentage of 50%. Let's also say that their HAPC is 8,333. So because this member is coordinated with Social Security in the 1976 tier, we reduce the HAPC by $133. So that brings the HAPC down to $8,200. and we multiply that by the 50%, and that yields a basic retirement income benefit of $4,100. Because this member is under age 65, the retiree gets an additional $6,650 as a Social Security supplement, and it's calculated by taking the $133 offset and multiplying it by the 50% benefit percentage, and that will restore the offset for a total gross monthly benefit of $4,166.50. Now let's go ahead and take a look at another example. This is for a 2013 tier member who's considering retirement at age 65. To calculate this member's benefit, we take the age factor for age 65, which is 2.5%. Let's say that they have 20 years of service, so we multiply those two figures together, and that'll yield a benefit percentage of 50%. Let's also say that their HAPC is $8,333 per month. So multiplying the HAPC by the benefit percentage would yield a basic retirement income benefit of $4,166.50. Now please note that there's no reduction. There's no Social Security offset of $133, as this is not a 1976 tier member. Now these estimates are great for illustration purposes, but you're probably wondering, well, how do the numbers look for myself? So to estimate your own retirement income, you can actually log into the UC Raise at your service portal, which is just retirement@yourservice.ucop.edu. It's listed at the bottom of the slide there. And on the left, you'll notice that there's membership details, which that will show you the amount of service you have, in what tier you're in, what your prior UCRP contribution and contribution balances are, as well as if you have a cap account, what that is. But the middle, you'll notice that there is a retirement button. And if you click on that button, that would allow you to both prepare retirement estimates, and once you're ready to elect, you can initiate your retirement through the UC Raise portal as well. On the screen, you can view the basic retirement income estimates for various ages, including any temporary Social Security supplement or lump sum cash out you might be eligible to receive. On the page also, you can click on the Create a Retirement Estimate link, and this would allow you to prepare your own estimates and model different scenarios. You can choose your own retirement and separation date. You can add a contingent annuitant. If you have upcoming raises, you can input those, or a new higher salary rate. Or if you wish to reduce your percentage time worked in advance of retirement, you can change that as well. Now this tool will allow you to model various scenarios for your retirement at any time. If you elect monthly retirement income, you'll be paid that for the rest of your life. However, after you've been retired for at least one full year, you'll be eligible to receive an annual retirement COLA each July 1. So as an example, if you retire July 1 of 2023, you'll be eligible for your first retirement COLA on July 1 of 2024. If you had retired January 1 of 2023, you would not be eligible, you would not have been retired for one full year by July 1 of 2023. So you'd have to wait until July 1 of 2024 to receive your first retirement COLA. After that, you'll receive a COLA annually, and it'll be payable actually on your August 1 check. Now, cost of living adjustments actually are based on the annual movement in the Consumer Price Index, based on a blend of the San Francisco Bay Area and Los Angeles metropolitan areas. And they're generally between 1% and 2%, with a maximum of 6% depending on that CPI change. Now that we've talked about the calculation of the basic retirement income and the lifetime monthly income it can provide, UCRP also offers several ways you can provide monthly income to someone else in the event of your death. Now, these benefits include the post-retirement survivor continuance, which is payable to those eligible family members defined by the plan. This benefit is free and is available to those in the 1976 tier and safety members. Alternative payment options where you can reduce your monthly income to provide lifetime income to a contingent annuitant is also available. This benefit is available to all members and can be payable to anyone. Now, if you pass away prior to retirement, there are provisions that allow certain eligible family members to receive monthly survivor income, depending on if you're eligible to retire at the time of your death. So let's go ahead and look at those in more detail. The first one is the post-retirement survivor continuance. This is automatic, and it's a monthly benefit that's payable to your eligible survivor, and your monthly benefit is not reduced to pay for it. So if you're a 1976 member who's coordinated with Social Security, your eligible survivor will receive 25% of your basic retirement income amount. If you're not coordinated with Social Security, or if you're a safety member, your survivor will receive 50% of your basic retirement income. Again, this provision is available only to those of you in the 1976 tier or membership tier, and is not available to those in the 2013, modified 2013, or 2016 tier. Now, you can't choose the eligible survivor for the post-retirement survivor continuance. Eligible survivors are defined by UCRP in the following order. Your spouse or domestic partner, if you've been married or in a domestic partnership for at least 1 full year prior to retirement. To verify the partnership or marriage date, suitable documentation must be submitted as part of the retirement process. And examples of acceptable marriage or partnership evidence would include a copy of the marriage certificate, copy of the registration of domestic partnership if it's registered with the state or equivalent jurisdiction, or if you're not registered, if your domestic partnership is not registered, then the UBEN 250 Declaration of Domestic Partnership form with 2 pieces of evidence showing financial interdependence must be submitted. Now, if you are in an unregistered domestic partnership, I would encourage you to go ahead and complete, if you have not already done so, I would encourage you to go ahead and complete the UBEN 250 now and submit those 2 documents to, and submit them to Office of the President, to the Retirement Administration Service Center, addresses listed on the form, in order to demonstrate or to document that you've got an unregistered domestic partnership. Otherwise, should you die before that declaration is made, then the partner would not be eligible for this benefit. So if there is no spouse or domestic partner, then the next category of individuals that the university would look for to pay the post-retirement survivor continuance benefit is eligible children. Eligible children are children under age 18 or under age 22 and in school full-time, or disabled if they're disabled prior to that age. If there are no eligible children, then the next individual that the university would pay the survivor continuance benefit to would be eligible dependent parents. Now, if the person receiving this benefit dies, or if a child receiving the benefit reaches that age maximum and becomes ineligible, the benefit will continue to the next survivor. And that would continue as long as there is someone eligible to collect the benefit. Beside the post-retirement survivor continuance, there's another provision that allows you to choose one of several alternative payment options to provide someone with lifetime income after your death. We call this person a contingent annuitant, and they can be anyone that you choose, including your eligible survivor, or it could be someone else, like an adult child. Now, this provision is available to all tiers, and when you choose this option, your monthly retirement income is reduced, and that reduction is based on your age and the age of your contingent annuitant at retirement, as well as the option that you choose. Now, if your contingent annuitant is not your spouse and is greater than 10 years younger than you at retirement, your options may be limited under the Internal Revenue Code minimum distribution incidental benefit rules. You can contact RASC for more information. Now, the election of a contingent annuitant is an important decision because once you retire, the choice is irrevocable. So, for example, should that person pass away before you do, the benefit is not transferable to someone else, and you continue to receive a reduced pension. So let's take a look at an example. This chart outlines the alternate payment options. In this example, this person's a 1976 tier who's coordinated with Social Security, electing to retire at age 60. So we're using the 2.5% age factor. And let's say the member has 15 years of service. So the benefit percentage is 37.5%. So let's say their HAPC was $66.21 per month, and reducing it by $133 brings it down to $64.88. So as a result, the basic retirement income benefit is $24.33. Now the member is married or partnered, and they've been in that partnership or marriage for at least 1 year prior to retiring. So the eligible survivor benefit is calculated, and it's 25% because the member's coordinated with Social Security. So it comes out to $608. Now, let's say that the member is naming that spouse or partner who is 57 years old, for example, as the contingent annuitant. So the alternate payment option A, B, C, and D are presented. So by selecting one of the alternate payment options, you'll notice that the lifetime monthly payment to you is reduced based off of your age and the age of your contingent annuitant to provide the additional contingent annuitant payment. You notice that column labeled contingent annuitant. And just as an example, the amounts are outlined below. So option D is only available to 1976 tier members that are coordinated with Social Security where the spouse or domestic partner is also named as the contingent annuitant. And that's exactly half of the member's benefit. Now again, to model numbers for you and any contingent annuitant that you'd like to designate, you can do that through the retirement estimator on the UC Raise at Your Service portal. This second chart outlines the alternate payment option without an eligible survivor. So this could be because the member doesn't have an eligible survivor or has accrued service in a tier that does not have the automatic survivor continuance. Now this benefit to the contingent annuitant, if you elect one, is payable for their lifetime following your death. Now, not portrayed in either chart are any applicable cost of living adjustments that would apply to both the member and survivor benefit once pension benefit begins. Now, the prior two survivor provisions were based off of scenarios where you have already retired. So if you pass away prior to retirement, certain eligible family members may be eligible for income or benefits as well. Now, if you're eligible to retire at the time of your death, meaning that you have at least 5 years of UCRP service credit and meet the minimum retirement age requirement, then your spouse or domestic partner will be entitled to lifetime monthly income equivalent to the alternate payment option A. If you were to die prior to reaching the minimum age requirement, but have at least 2 years of service credit, your surviving spouse or domestic partner would be eligible to collect a percentage of your salary at the age of 60 for the rest of their life. If you have eligible children who are under age 18 or under age 22 in school full time, or a disabled child who became disabled prior to those ages, they may also qualify for monthly survivor income. So if upon your death prior to retirement, you don't have family members that qualify for these benefits, then UCRP will refund your contribution and interest to your designated beneficiary. On UCNet, you may access the survivor handbooks, which outline these provisions in detail. So honestly, the handbooks are a handy document to have as it outlines the general steps necessary to initiate the survivor process. In addition to the monthly survivor benefits that we just looked at, another benefit of UCRP is the one-time basic death payment. It's of $7,500 and it's payable to your designated beneficiary or beneficiaries. The basic death benefit is in addition to any monthly income that may be payable to your eligible survivors or contingent annuitant. Again, provided is the link to the publication resources, Your Guide to Survivor and Beneficiary Benefits for Family Members and Beneficiaries. So again, if you go to the UCNet website, under the HR Forms and Publications, click on Subject, and you'll be able to see death benefits. And again, it's a handy document to actually have with all of your other financial documents for your survivors. So that way it's all consolidated in one handy spot. Now, as a member of UCRP, you make contributions into the retirement plan based on a percentage of salary. This percentage is based on the membership classification, your tier, and bargaining group. Any UCRP contributions that were made before 1983 were done on an after-tax basis, which means that it'll slightly reduce the taxability of your UCRP retirement income once you begin collecting that benefit. However, contributions made since 1983, contributions have been done on a pre-tax basis. Now, your contributions don't factor into the calculation of your UCRP benefit. As we discussed, the retirement income is based on your age, years of service, and salary at retirement. Your contributions, along with those made by UC on your behalf, do, however, help fund the retirement benefit. So upon retirement, your UCRP contributions are not payable as a separate benefit. They are simply moved into the pension trust, which will be used to fund your pension benefit following your retirement. Now, in the event of your death and the death of any eligible family member, survivor, or contingent annuitant, so if the total UCRP benefit that was paid to you, those survivors, and contingent annuitant are less than the total amount that you contributed into UCRP, along with any accrued interest through the retirement date, the remaining balance would be payable to your named beneficiary. So at this point, we've discussed the monthly retirement income options when you retire, which are available to all membership tiers and classifications once you're vested. Now, let's go ahead and look at the lump sum cash out option, which is an alternate form of UCRP income that is in the 1976 tier, modified 2013 tier, and safety tiers that can be elected in lieu of monthly retirement income. So the lump sum cash out is a one-time lump sum payment in lieu of monthly income. It's based on the present value of the basic retirement income, and you would receive it that you would have received over your life expectancy. Included in that calculation are any assumed cost of living adjustments in the projection. You can use the retirement estimator on UC Raise to estimate your lump sum cash out. And again, lump sum cash out is available only to members of the 1976 tier, safety, or modified 2013 tier. It's not available to those in the 2013 or 2016 tier. Now, if you elect a lump sum cash out, you'll give up all other UC retirement benefits, including retiree health, the basic death benefit for your survivor, as well as any other survivor or contingent annuitant provisions. Sick leave will not be converted in calculating the lump sum cash out, so sick leave will not be converted to service credit. And if you elect the lump sum cash out, you can also not return to a staff career position at UC. Now, while a lump sum cash out can work for some members, since it is a one-time payment based on average life expectancy, you should consider what could happen if you live longer than average and could possibly outlive the lump sum cash out. So how would you provide for your health care? Um, how would you provide any income? So these are important things that you need to consider before selecting this option. Now, the lump sum cash out is subject to federal and state taxes in the year in which you receive it. You may, however, defer taxes until you receive distributions by rolling it into another qualifying plan, such as the UC retirement savings plans, which is the 403B, 457, or DC plan, out to another employer plan or qualified IRA if they'll accept it. The amount for rollover may also be limited to the Internal Revenue Code 415, and a rollover to a Roth is also available through this provision. However, it still would create a taxable event. Now, once you choose a lump sum cash out in lieu of the monthly benefit, that decision is irrevocable upon the retirement date. So it's very important that you can consider all of your options and make an informed decision. See the retirement section of UCNet website for more detail about the lump sum cash out. Okay, so now that we've explained how the pension benefit itself is calculated, let's take a look at how your paychecks would compare to your retirement payment. So if you're a longtime UC employee, you might find that the amount of your retirement payment is really not that much different than employment check. As an employee, there's a lot of deductions that are withheld from our paycheck. So this includes federal and state taxes, Social Security, Medicare taxes, the cost of your health insurance premiums, and any voluntary contributions that you make to the retirement savings program, as well as the mandatory employee contributions to UCRP. Now, this doesn't include any other voluntary deductions such as disability, life, legal insurance, transportation and parking expenses that you have deducted from your paycheck. And all of these deductions, reduce our pay from the gross paycheck to the net paycheck, which is the amount that we live on, right? So in retirement, you no longer pay Social Security and Medicare taxes. So right there's, about 7.65% that will not be deducted once you retire. You also don't pay UC's retirement contribution. So you're not paying into the retirement plan. So that right there also, anywhere from 7 to 9%, depending on what tier and what bargaining representation you have. Also, any other voluntary retirement savings contributions that you make would also not be deducted. And many of the employee insurance deductions like life and disability insurance will not be deducted as well. Those plans basically end, so they're not amounts that you can have deducted. Now, even though the cost of the retiree medical plan goes up in the retirement, after deducting the insurance premiums and federal and state taxes, really the net benefit actually may be closer than what you would normally think. Now let's go ahead and look at some of the other potential sources of retirement income that you might have. Through UC, in addition to your UCRP pension, most UC employees will have other retirement income that they've earned or saved during their career. This can include the capital accumulation payment, or CAP, anything that you've contributed into the retirement savings programs, such as the DC 403B, 457 plans, any Social Security benefits that you may have accrued while through your UC employment, and any other agreements with any other retirement system that you may have previously participated in. So the first one is CAP. Now, if you worked at UC in the early 1990s or 2000s, you may have received one or more CAP allocations during those years where there were state budget crisis that led to salary freezes and time reduction programs. Eligible employees receive these allocations from UCRP based on a percentage of their covered compensation that were earned during selected or specified periods. Cap 1, which were awarded between 1992 and 1994, earned annual interest of 8.5%, and allocations that were made in 2002-2003 as part of the Cap 2 program earned interest based on the actuarial assumption. So currently, the actuarial assumption is 6.75%. When you retire, you must take a distribution of your cap balance. If you take all or a portion of your cap money as a distribution that's payable to you, it'll be taxed as income in the year that it was received. However, you do have the ability to defer taxes by rolling over all or a portion of your cap account directly into your existing UC retirement savings programs, out to a traditional IRA, or to another employer plan that'll accept a rollover. Now you can view your current cap balances, and the system will project a cap account if you have cap already, and you'll be able to view that by logging into the UC Raise account. Payment will be issued following the first pension check or lump sum cash out, whichever, whether you elect monthly or the lump sum payout. Another source of potential retirement income may come from the retirement savings program. As an employee, there are many ways in which you can supplement your pension through the UC retirement savings program. Eligible employees can make contributions to the defined contribution plan, which includes a voluntary after-tax component, a mandatory pre-tax component for those individuals actually who were in UCRP between 1990 and 2010, DCP Safe Harbor, which is for individuals who were employed in positions that were not eligible for UCRP membership, DC Supplement, which is if you are in the Pension Choice program, and DC Savings Choice. So if you contributed to the DC Savings Choice before making a second choice election to move into UCRP. UC also offers voluntary pre-tax savings options through the 403B and 457 plan. For 2023, individuals may defer $22,500 to each plan, and if age 50 by December 31st or by end of the year, an additional $7,500. For any of the pre-tax retirement savings plans, you can take in-service distributions starting at age 59 and a half. Once you retire, you'll cease contributing to these programs. If you're not already enrolled in the 403B or 457, you would like to start saving additional money for retirement, you may set up automatic payroll deduction and manage your investment through Net Benefits, the Fidelity portal. You may also view your current account balances online through that site. When you retire, your contributions into the retirement savings plan will stop, but you have several options for your monies in these plans. You can leave the monies on deposit if you have at least $2,000 in the account. If you have less than $2,000 in any of the plans, you can withdraw those funds, but you do have the ability to roll them into other accounts. So for example, if you have $10,000 in your defined contribution plan and $1,500 in your 403B, you could roll your 403B into the DC plan to leave those monies on deposit. Now, while you can no longer contribute to the program, in addition to maintaining that account, that would allow you to request distributions or set up systematic withdrawal, so that way you receive a fixed amount per month. You maintain the ability to manage those investments, so you can transfer your monies among the different funds or roll them over into other qualifying plans at any time. You also can take full or partial distributions of the money or roll over them. So once you retire, you may take your first distribution no sooner than 31 days after your last day of UC employment. Now, whenever you take money out of the retirement savings program, you will pay taxes on the pre-tax portion, plus any earnings on those contributions as income in the year that you receive that money. However, you can defer taxes by rolling over those funds into another qualifying plan, such as an IRA or an employer plan that will accept those rollovers. Now, if you receive money from your DC plan or 403B before you turn age 59 and a half, you might be subject to an early distribution penalty, which is a 10% federal penalty and a 2.5% California state penalty. Early distributions, however, will not apply to the 457 plan money. You would not be subject to early distribution penalties if you leave UC during or after the year in which you turn 55. There are additional situations in which the early distribution penalty may not apply, and I'd encourage you to refer to the retirement handbook and or the special tax notice on UCNet for more information. Now, IRS does require retirees who are older to take minimum required distributions. So if you leave your money on deposit with Fidelity, they'll set up your minimum required distribution when the time comes. Now, if you're older at the time of retirement, or if you are subject to the MRD at the time of retirement, any rollover from CAP or the lump sum cash out would also be subject to the MRD. The Secure 2.0 Act actually has made updates to the minimum required distribution rules, and it's being phased in over the next several years. So you'll see changes to the required minimum distribution over time based off of that, the federal act. Another source under the retirement savings program is the deferred lifetime income option. Starting in 2021, UC added a new way to have guaranteed income in retirement. Between the ages of 62 and 69, you have an annual opportunity to convert a portion of your retirement savings balance into an annuity that will provide lifetime monthly income starting at age 78. You can even elect an option to provide a joint and survivor annuity to provide lifetime monthly income for yourself and your spouse. For more details about this option, including plan limits and when the annual window opens, please visit myucretirement.com and select retirement income, then select strategies for more information. A third potential retirement income source is Social Security. Now, most employees pay Social Security taxes through their UC employment, and UC is also contributing to Social Security on their behalf. You can receive Social Security benefits as early as age 62, but the age at which you can receive your full benefit depends on the year in which you were born. So, for example, an individual who was born in 1960 or later, the full retirement age would occur at age 67. So depending on how much earlier you are from your full retirement age under Social Security will define how much of a reduction is applied by Social Security. You can visit the Social Security website, which is ssa.gov. You can set up an account if you haven't already done so. I would encourage you to do that. But that would allow you to view your historical Social Security contributions. So that way you can, confirm that your Social Security record is correct. But also through that site, you can actually model, different scenarios. If you began drawing it as early as age 62, what the benefit would be, or if you waited until 65, or you waited until your Social Security normal retirement age, or even if you waited until age 70 to begin collecting, their system would allow you to go ahead and model those numbers to see what the projected benefit would be. You can also find more information with regards to survivor benefits as well as qualifying for benefits based off of your spouse, a deceased spouse, or even a former spouse's employment record. So definitely I encourage you to go ahead and set up and view the socialsecurity.gov website to get more information. Now, some employees actually who were hired before 1976, as well as safety members, don't pay Social Security taxes through their UC employment. And UC doesn't pay into Social Security on their behalf. So as a result, those individuals may not be eligible for Social Security, at least based on their UC employment. So if they've had accrued service, or I should say Social Security contributions and earnings through other employers or even through their spouse, they may qualify for Social Security benefits based on that. But if you do not pay Social Security taxes as a UC employee, but are eligible for Social Security income from another source, Social Security Administration may limit your benefit. So since you haven't contributed to Social Security and your UCRP pension benefit is considered a government pension, there are provisions that may reduce the Social Security benefit that you receive through Social Security. And those would fall under the windfall elimination provision and or the government pension offset. Social Security can provide you with more information as far as whether those provisions apply and how they would apply and reduce your benefit from them. Now, for other retirement system agreements, UCRP has agreements with the CalPERS, Public Employees Retirement System, and the California State Teachers Retirement System, or CalSTRS. So to qualify for reciprocity with CalPERS, you must have left CalPERS employment and started at UCRP in an UCRP eligible position, or vice versa, within 180 days. You must also retire from both systems on the same date. To qualify for the concurrent retirement with CalSTRS, you must have been an active UCRP member on or after July 1 of 2002 when UCRP entered the agreement from CalSTRS. While you don't have to retire from both systems on the same day, you can retire from one system and earn service. You cannot retire under one system and earn service credit in the other system at the same time. And while benefits from each system are paid separately, the advantages of reciprocity or concurrent retirement are that your service credit from one system can be used to determine vesting in the other system. We also may use the higher salary rate in either system to calculate your benefit from both systems. Okay, so there's advantages actually to the reciprocal agreements. Now, other public pension systems in California, things like the county retirement systems and a few others, they might have some similar agreement, even if UCRP doesn't have an agreement with their system. So if you've worked under another public pension system, I'd suggest maybe reaching out to them to see if there's any provisions that you can take advantage of when it comes to shared vesting or salary provisions. While it's not something that UC would recognize, it's something that they may recognize when they calculate any eligibility or benefit payments from their system. It's no guarantee, but the worst thing that can happen is that they would say, no, we don't. So if you've got other pension accruals in other systems, I definitely encourage you to go ahead and reach out to them to see if there's any provision that you can qualify for to enhance or qualify for any benefits from them. Now, one of the other important factors or benefits that are offered through UC to eligible retirees is retiree health for you and your family members. And for this, I do want to encourage you to find out more information with regards to the retiree health program by attending the UC Retiree Health Benefits webinar. It's offered on the third Wednesday of each month at 2 o'clock. The schedule, registration, slides, and even a pre-recorded version are available on UCNet. So from the UCNet website, if you click on the compensation and benefits tab and then look at the retirement benefits and then go to retirement planning webinars, or just in your search bar on UCNet, type in retirement planning webinars, and that'll bring up the page where you can view that information. And again, it complements this class. So in addition to preparing for retirement, the Retiree Health Benefits webinar will provide additional information with regards to retiree health benefits that can be extended to both you as well as your eligible family members as a retiree. So if you think you're ready to retire, here's several steps that you'll need to take. We also do offer a retirement process class, which I'll highlight, as we get through that section. So there's some steps that you should consider as you're making your preparation. Definitely attend the UC retirement planning workshops and webinars. So you're attending this one, and then there's 2 others. There's also a variety of webinars that are available through Fidelity as our workplace consultant team. They can provide information, and there's a variety of website presentations that will help you as you make your plans. In addition to attending the webinars, the UCRP estimates and also the retirement savings program balances, you should take a look at those. So again, the UCRP estimates you can run through the UC Raise portal. We demoed that screen a little earlier. And then also the net benefits portal is actually where you can find your balances in the retirement savings programs. So again, the DC, and if you contributed voluntarily to the 403B and 457, you can find those balances out there. Again, also take a look at the Social Security website to see what your projected benefit could possibly be from that. You can meet with a Fidelity Workplace financial consultant. That's an excellent way to get an overall picture. So, it's always a good idea to have your balances, estimates, Social Security projections, any other information that you've got available from any other sources of benefits or income that you might have access to. And that'll help in that discussion with the Fidelity Workplace Financial Consultant to get an overall picture. So again, definitely you want to reach out to former employers to see if there's anything that you can qualify for through them. And also, if you have a financial, or if you have your own financial or tax advisor, definitely meet with that person as well to go ahead and take a look at a bigger or overall picture. And certainly, you do want to make sure that you've got your personal finances in order. Part of that process, actually, I would encourage you to double check or verify that your beneficiaries are set up. Your beneficiary information are housed or can be housed on both UC Raise, which would be the beneficiaries for things like the death benefit payments from UCRP, as an active employee, life insurance, as well as AD&D insurance and business travel accident insurance. That information is out there as well. And then also on the Fidelity portal, where you can verify who your beneficiaries are designated for your DC 403B and 457 monies. So make sure that you do keep those beneficiaries up to date. Put it in as part of your annual process to take a look and update them as necessary as those individuals move or as beneficiary changes are necessary to be made. You should definitely select a retirement date and begin the process about 3 to 4 months before your intended retirement date. Okay. So again, we talked about the separation date and the retirement date being 2 distinctly different dates. So you can initiate that process, the retirement process, 3 months ahead of time. So for staff employees, probably a good place to start that discussion with regards to separating and retiring would be with your department. So either your supervisor or manager. For academic employees, Also, a good place to start is your department. So primarily things like your department chair, but also your dean's office or your academic personnel office at your location can assist with definitions or as far as any criteria with regards to defining the retirement date. One of the considerations is for academic year faculty. I would encourage you to reach back out to your dean's office or academic personnel office. But in general, part of the focus for academic year considerations would be things like this, that the service period can differ from the payroll period, meaning that for a fall quarter academic year faculty member, the payroll period for fall quarter more or less runs from July through October, whereas the service period on the quarter schedule more or less, late September to December, more or less. So there's distinct differences between the service period and the payroll period. So when an academic year faculty says that they want to retire at the end of fall quarter, even though service period goes through December and the academic year faculty might be thinking that it would be a January 1 retirement, in reality, based off of the payroll period, an academic year fall quarter retirement would be November 1st because the separation date for fall quarter payroll would be October 31st. As an example, it could vary by location and by you know, by location. So I do want to encourage academic year faculty to talk about those kinds of things with either the department chair, again, dean's office or academic personnel office as part of your decision to set your retirement date. Now, once you've determined what your retirement date will be, you can initiate your retirement within 90 days of that date. So to begin that process, most individuals will log into the UCRaise portal. Again, select the retirement icon, and then from there you'll see the initiate and elect retirement. So you'll be able to create a personal retirement profile or PRP just by following the prompts and entering the details of your planned retirement, including both your retirement and separation date, as well as any information regarding any survivor or contingent annuitant that you'd like to run numbers for. Now, once you've done that, you'll be able to view your retirement profile details, including an estimated retirement income options, as well as eligibility for retiree health, if applicable. Now, if you're unable to use UCRaise or if you encounter any issues, you can contact RASC or complete and submit a request for retirement initiation packet. And that will initiate your retirement process manually, and you'll receive a PRP. You'll receive your PRP, and that'll typically come through the UCRaise messaging and possibly a hard copy packet mailed out to you. But the form itself to manually initiate the process is available on UCNet. So ucal.us /retirement form. But also, if you just go to the UCNet website and do a search for retirement initiation packet, you'll be able to access that form as well. Now, once your personal retirement profile has been generated and issued, you'll be able to review the various options that are available and decide which best suits your needs. Okay. Now, your personal retirement profile provides your personal UC retirement data, and it also includes the projection of the retirement income, eligibility for retiree health, and the percentages of UC contribution towards retiree health premiums. A good companion piece is the retirement handbook. So I'd encourage you to read through it, and that'll help you to fully understand the retirement options, but you can always contact RASC for any questions to assist you through that process. Now, if you are married or have a domestic partner, be sure to also fold that person in during your discussions. Their signature will also be required on the election form. But once you're ready to proceed with your election of retirement, you can log back into UCRaise and complete the election process. If you're unable to do the election through UCRaise, in the packet that was provided there would also be an election planning worksheet that you can complete and return to RASC, so that way they can go ahead and produce the election form for you for signature. So for the election process, again, you can log into UC Raise and select the retirement icon, and then again, initiate and elect retirement. From there, you can select your PRP and elect retirement, and then follow the prompts to prepare your retirement elections. So if you have generated multiple PRPs, make sure that you're selecting the correct one or the one that you want to retire against when you make those elections. Once you've made your elections and you've completed that process, then you must sign the election and submit it to RASC. You can sign your election electronically through UC Raise, or you can print and sign a hard copy and then mail it to RASC or upload it via UC Raise. If you are married or have a domestic partner, that individual must also sign the election as well. This is a good opportunity to upload any required documents. Again, we had that discussion earlier when we were talking about the survivor benefits. So in the case of a spouse or domestic partner, that certification, either marriage certificate or the domestic partner documentation. If you are naming a contingent annuitant or have eligible children, then birth evidence for that individual will also be required. So make sure that you do upload that information as well. Now, once RASC receives the completed and signed election form, as well as all supporting required documentation, they'll process and review your retirement election and retirement calculation. Okay. And you'll be able to track the progress through UC Raise. So when you log back into the UC Raise portal, typically if you scroll down towards the bottom, you'll see the status updater there. And then you'll receive a confirmation letter roughly in about 45 days to 60 days, depending on how long it takes RASC to complete the review. And once they've processed everything is when they'll submit or when they'll issue the confirmation letter. So RASC will reach out to you if any additional documents are missing or needed. Now, if you want to change or cancel your retirement election, you may do so via UC Raise or by contacting RASC directly at any time up to your retirement date or 15 days after the confirmation letter is sent, whichever date is later. Once that window closes, the election is locked to be altered. Now, I do want to point out that there is another retirement planning webinar. Kind of showed it, early on during the presentation, but it's called the UC Retirement Process Step-by-Step webinar. And this one, again, is offered on the fourth Thursday of each month at 10 o'clock. Schedule, the registration, slides, as well as a pre-recorded version will be available on UCNet. And this one actually goes more in detail. So step by step through the screens that you'll need to use in order to access the UC Raise portal and make your election. So both creating the PRP and actually doing the election online. And also it talks more in detail as far as the steps after the election has been submitted up through the payment setup. Okay, so you can actually access it again through the UCNet website under the compensation benefits tab, click on retirement benefits and then click on retirement planning webinar, or just do a search on UCNet for retirement planning webinar and it'll bring up the page that you can click on. So now that you've retired, let's go ahead and look at some of the things that'll happen after retirement date. Okay, so the first thing is what to expect with the retirement payment. So if you elected a monthly pension, then your first retirement benefit payment will usually come around the first of the month following the retirement date. So, just as a quick example, if you retired in May 1, for example, the first retirement check would come around June 1st. So depending on timing, it's possible, depending on when you submit the election, whether the election is completed and all that, it is possible that there might be a retroactive payment due to a late payment being made. But when it comes to retirement payments, you've got the ability to do direct deposit. Just like with active employee checks, they can be direct deposited into your bank account. You can also do that with the retirement check, and that's a nice way actually. So that way you don't have to worry about a check being lost in the mail, and that the money just quote unquote magically appears in your account. Now you'll be able to view your income statements on UC Raise. So, just as an example, as an employee, you log into UC Path to view your pay stubs. As a retiree, you'll be logging into UC Raise to view that information. Now, retirement income is reported on a 1099-R form, not a W-2. And the 1099-R form for UCRP would be accessed through UC Raise. So in the first year that you retire, so let's say, for example, that you do retire July 1 of 2023, you would actually, in January 2024, that when the tax statements become available for that year, for the 2023 tax year, you would actually be logging into UC Path to get your W-2 for your wages that were reported, based off of your active employment. And then you'd also be logging into UC Raise in order to access your tax form, your 1099-R form for your UCRP pension benefit, lump sum cash out and or cap payment through UC Raise. So for the pension benefit that was payable in this calendar year. And then in subsequent years, unless you're working as a rehired retiree for UC, then you would not be accessing UC Path for that information. You would just continue to use UC Raise to retrieve your pension tax form. So as a retiree, you'll definitely want to keep your personal information up to date. So things like your address, phone, email, you want to make sure that that information is up to date on the UC Raise portal. So as those changes, be sure to log in. Through UC Raise, you'll also be able to manage your tax withholding from your pension payment. Any direct deposit changes can be made through that site as well. And again, as I mentioned earlier, your beneficiary designation and contact information for those beneficiaries can be updated and maintained on both UC Raise as well as the Fidelity Net Benefits portal. And as changes happen that require changes to your health benefits enrollment, you can do that through UC Raise. So annual open enrollment, for example, as a retiree, you'll be doing that through UC Raise instead of through UC Path. If you have or leave monies on deposit in your DC 403B and or 457 plan, then Fidelity, the Fidelity portal, netbenefits.com, will be where you'll be able to manage that information as well. In addition to UC Raise and or Net Benefits, another opportunity or way to stay connected with the university is through the New Dimensions newsletter. This is a quarterly newsletter with news about UC, anything about benefits, or even information about fellow retirees. So you'll be able to follow UC news and retiree insurance issues on both UCNet and also through the New Dimensions newsletter. Other sources, again, are UC Raise, UCNet, and myucretirement.com. So if you want access to any additional webinars that are available to retirees, that information typically would be made available through myucretirement.com. You also have access to local resources. So, your location or campus or medical center, they oftentimes, have resources that are available to their retirees. So there's the Emeriti and the retiree associations that you're welcome to join. Many of them actually have retiree or retirement centers. So that's a great way to stay connected with other retirees and with just your location itself. And then also there's healthcare facilitators who are available. Healthcare facilitators are available to assist retirees with issues with their medical and retiree medical and dental benefits, especially as you make transitions from or into Medicare. They can help assist you with making that transition more smooth. Now we hope that once you retire, that you enjoy all things that are involved with that new chapter of your life. However, if you do plan to come back to work here at UC, there are some rules that you need to be made aware of before returning. So the first thing is that you really should not discuss returning to work prior to retirement unless you are at your normal retirement age, which would be the maximum age factor. So either 60 or 65, depending on what tier you are. And you generally need to have a break in service of at least 30 days, though a break in service of 90 days is preferable. Upon returning to UC employment, your initial appointment must not exceed 43% time in a 12-month period. So if it's less than 12 months, obviously it could be a little higher just because it needs to be an average of 43%, or no more than 43% over that 12-month period. But after that 12 months, the hiring department must also follow same approval process as it did with the initial appointment. So they just can't extend it or renew it. Now, faculty appointments may also be renewed annually following review. But if your new appointment qualifies you for employee benefits, you may need to suspend your retiree medical benefit and enroll as an employee. So those are definitely considerations that you want to take into account when looking at returning to work at UC after retirement. Now, if you do come back in an eligible UCRP eligible position, in addition to suspending retiree health benefits, you must also suspend your pension benefit. In which case, by returning to UCRP eligible employment, you would earn service credit, possibly in a new tier. So if you were originally a 1976 member and retired, and then you come back, you would actually definitely be in either the 2016, or if there's a subsequent tier, you'd be a member of that tier as well. Now, once you leave that employment after returning in an eligible position, then you must re-retire the day after that position ends. Now, I will say also that if you do take a lump sum cash out, you are restricted from being eligible to be rehired into a UCRP eligible position. So essentially, you can't come back into a career position after electing a lump sum. There is a fact sheet that's available. It's called the Returning to UC Employment After Retirement Fact Sheet. So if you do get to the point where an opportunity to return to UC employment after retirement does come up, be sure that you access a copy of that on UCNet, and that will give you some more information. But definitely reach out to your either to your location or to RASC if an opportunity presents itself before even taking that consideration. Just because you don't necessarily want to go down the road and find out right before you plan on accepting that offer that you can't do that. So it's very important that you review that information before it gets to that point. So with that, I want to thank you for attending today's session. And again, there are the 2 additional webinars that discuss both retiree health and also the process, step-by-step process for electing retirement that I do want to encourage you to attend. And always, if you're interested in attending this session again, feel free to either attend the live webinar version or to review the recorded version again. So thank you all. You have a good day. Bye-bye.